I'm Steve Paulus, Head of Institutional Sales for Sparrow Capital.
Every time a company reports their earnings for the quarter, we'll actually go through their statement and look at how they are actually achieving their growth. And what we found is that a company that reports high growth, but it's a result of acquisition, then their success rate drops.
Mm-hmm.
And the reason why they drop is that even though the company's acquisition boosts their sales, that the price that they pay is typically too high. So they'll issue shares, or they'll have a bunch of write-offs on the next quarter. So we really want to see organic growth. And organic growth can typically be measured by unit volume and price change. So it would be better to have a company that's growing through unit volume and increased prices than by acquisition.
Kind of as a sidebar, we're hearing a lot about share buybacks these days. How does that, in your view, affect the value of a quarterback we've chosen to put in our portfolio?
Right. We don't look at share repurchases. Actually, we don't think there's much correlation between the company's value change. Now, a lot of people do look at it. They look at dividends, they look at share repurchase.
Mm-hmm.
The way a lot of companies that we invest in don't pay dividends, or they don't buy back their shares. They're actually capital hungry because they're growing so fast that they need capital, and they don't have the spare cash, so to speak, to buy their stock. I mean, look at IBM, for example. How many years were they purchasing their shares? And the stock continued lower. So we haven't found any statistical correlation between share repurchase and increased shareholder value.
Okay, good. So you had mentioned earlier what areas you focus on in terms of what are most likely to, based on conditional probability, what's most likely to outperform. Once you're putting your portfolio together, let's look at the other side. What's your reason or motivation to take something out of a portfolio?
That's a good question. What we think about is that if you have 100 investments in your portfolio, you have to continually monitor those investments against new ideas. So every quarter, we will do a resort of the market of the stocks that are available to invest in, or companies, and inevitably a certain percentage of those investments that you had are not going to be growing as quickly. Something changed, competition, the economy, and you're going to have other ideas. There are new drugs that are being launched. There are new websites that are being launched. There are new software companies that are going public. So you have to continually monitor all the available choices, make the comparison as objective and unbiased as possible. You have to be completely unbiased in your opinion, except for what the data tells you. And if you can do that, it's hard to do. Human beings are biased. They're prejudiced, right? You like a certain car, you like a certain color, right, for your car, you like a certain horsepower for your car. So you have to separate that bias in stock selection, because the market doesn't care about what you think. It really doesn't. It's going to reward investments such as Amazon or Google because they provide a better service, they're growing faster than other available choices.
Mm-hmm. And as I understand it, you really don't have any constraints in the sense of locking yourself into a particular part of the market.
No, most of our portfolios have an unconstrained mandate. So we're able to pick from all available choices to invest in. And the reason why we do it that way is because all of my capital is invested in this strategy, and I don't want to be left out.
So you're putting your money where your mouth is.
Exactly, and that's why I keep it unconstrained.
Unconstrained also goes outside of the U.S., correct?
Right,
And
right.
so what are you seeing in terms of, I'll leave it to you, either risks or opportunities, given where we are in the world right now, with markets outside of the U.S.?
We do get opportunities in our data set to select companies that are foreign-based, and usually the risk is higher, so it reduces the expected value, correct? Because the probability of success is lower due to currency effects, politics, monetary policy differences. So we do get an opportunity to invest in companies that are outside the U.S., but typically they are the larger companies. And that's kind of how we work that, because the success rate is higher and the volatility is less with the bigger companies than the domestic companies.
Makes sense. You can reach us at sparrowcapital.com or call me, Steve Paulus, 314-725-6161, extension 15.